Hi everyone, we are live. My name is David Kosmeter. I am the creator of Timing Research, and this is our show for January 20th, 2015. Today we will be discussing the 69th weekly report. If you have not had a chance to download this yet, just go to TimingResearch.com/reports, and you can get a copy there. I have Dave Landry guest hosting for me again this week, so I'm going to go ahead and turn over the show to him.
Okay, David Kosmeter, once again, thanks to you. Thanks to TimingResearch.com for having me back once again. This week we have George and Milton, FinancialJuice.com, and they're also UnusualActivity.com. We got Stephen Place of InvestingWithOptions.com and Todd Gordon of TradingAnalysis.com. All of these people are friends of the show, so we want to welcome you back to the show. Let's start with question 2, and this is going to go to George and Milton first, Financial Juice or UnusualActivity.com. Based on any technical or fundamental indicators you want to use, would you guess the S&P index will move higher or lower by the end of this week? And that's Friday's close of January 23rd. And on that prediction, give us a confidence, with 0 being zero confidence and 10 being fully confident.
Well, this is this is Milton. I'm gonna take this one. We believe that fundamentally wise, I can go, I guess, with all the news with the ECB in Greece over the weekend, we believe that the markets will end up lower, with a possible 7.5, 8 on the confidence scale on that one.
Okay, fantastic. And one thing I forgot to tell you, or ask you, I should say, before we get to the next question, in fact, right now, tell us a little bit about Financial Juice and UnusualActivity.com.
Sure. Thank you. So Unusual Activity is our service, and it can be found on FinancialJuice.com. What it is, it's a real-time market information filtered with volume and price, and we concentrate on larger than usual option plays and trades, blocks. We concentrate on insider transactions and filtered social media news.
Interesting. Very interesting stuff going on over there. Okay, Stephen, let's go over to you. Tell us a little bit about yourself, your trading, and investing with options.com.
Sure. Thanks for having me. My name is Stephen Place. I am the founder and head trader at investingwithoptions.com, where we teach people how to become better option traders. My edge lies in understanding volatility, both what has happened in the past and what the options markets are predicting in the future, as well as overlaying that with my own personal style of technical analysis.
Fantastic. Okay. All right, Steve, well, we got you here. Based on any fundamental or technical indicators you want to use, would you guess that the S&P will move higher or lower by the close of Friday of this week?
Well, fortunately, we've had a market holiday, so we have one less day of uncertainty to deal with. It's really interesting because this is such a pigeonholed kind of question, and my trading style is more of a function of if-then statements. I'm going to lean bullish simply because the markets are failing to roll over, and we are at the bottom end of a range. We've been in a range between November and January. On the S&P, it's around 1975 all the way up to about 2100, just a little under 2100. And since we're at the lower end of that range, and that we're failing to roll over with all of this bad news in front of us, I'm going to lean bullish. About a 6 or 7 on the confidence scale. One of the other indicators that I love to use is the relationship of the VIX relative to VXV, and it shows us when investors are really scrambling for hedges because they're concerned about short-term action. Whenever we see a move above 1, it tends to tilt bullish for the options signal towards the markets. And we're seeing that again. So yes, we've got the ECB and we've got some other fundamental voodoo coming up, but I think that those that needed to sell sold, those that needed to hedge have already hedged, and it's just incredibly difficult to take this market lower. I'm wrong if the market loses 1975.
Okay. Well, I tell you, it could have saved me a lot of time. I could have just pointed my readers your way this morning. I agree with most 99% of everything you just said. Before we get to that, let's go over to Todd Gordon. I know Todd from a long time ago. He and I were affiliated with a website called TradingMarkets.com, so we go way back. And then we both went our separate ways. And a couple years later, I turned on the TV, and there he was. So he's now become a very famous trader. Todd Gordon is of TradingAnalysis.com. Todd, for those of us who don't know you, tell us a little bit about yourself, your trading, and TradingAnalysis.com.
Sure, thanks, Dave. That's I think you're the real famous one here. I'm just trying to follow in your footsteps. Guys, thanks so much for having me. And Dave, great to talk to you. Like we're talking before
Likewise.
the show. It's got to be about 10 years, I think. I think last time we talked must have been 2002, 2003. So, wow, it's getting up there. But that's the great thing about this business. There's guys who've just been around a long time, and as much as we like working with clients and doing these shows, we like hanging with each other and talking to each other. That's something I've always enjoyed about the industry. So, but yeah, my business, TradingAnalysis.com. I run a research trade advisory business. I trade my own capital, and basically I try to get clients to look at the markets if they so choose in my way. I like to be a pre-planned trader. I like to use certain kinds of technical methodologies that might be deemed a little bit more complex than usual, and I do think that kind of gives us an edge in terms of being able to look ahead in the market and setting up trades. We trade mostly stock options. I do have a background in foreign exchange, so I do trade, put on currency positions every now and then, and obviously with Swiss franc it's been wild. But we've had a great dollar move. We have positions on in gold right now. Stocks I think are incredibly difficult right now. The S&P is difficult, so we can go in any variety of directions you'd like to go, but we like to take kind of a macro approach, utilizing options within our technical and fundamental model.
Cool stuff. Cool stuff. All right, Todd. Based on any technical fundamental indicators you want to use, would you guess that the S&P index will move higher or lower by Friday, the close of the 23rd?
Okay. Well, considering that the Patriots are going to the Super Bowl, I'm going to extrapolate the Yankee effect. Basically, if the Yankees go to the World Series, the New York Stock Exchange is supposed to rally. So I'm going to go over to football as well and say because the Patriots are in, I think the S&P sells off. No, I'm kidding. The S&P is incredibly range bound right now. I think there's a lot of signals right now, namely bonds on a tear, gold on a tear, dollars higher. As I think Steve said, volatility is quite high right now. There's a lot of uncertainty. I have to think to a certain degree that the ECB has been cooked into the market. Anything less than $1 trillion disappoints. Greece exits, obviously, pricing in terms of volatility. I have to think that there's so much kind of volatility priced in right now. The market should be lower, and it's not. So I'm gonna say with very low confidence, I think it's the least clear major asset class right now. I think while 1997 S&P cash holds, I think we finish higher at the end of the week.
Okay. What level of confidence would you give that?
I mean, just give me like 10 basis points over 50-50. I'm telling you. I just looking at, I have two scenarios in the S&P, and both are equally probable right now. We're just seeing sideways range. I mean, this is the same level that we saw since October 30th. I mean, we've been just range bound, whipping back and forth in 100, 200 handle ranges in the S&P. There's been no real net change with massive volatility. There's a lot of, as I said, intermarket kind of signals that the market should be lower, and it's not. It's holding a great bid, so you got to think there's an underlying bid to it.
Yeah, good analysis. I agree. My name's Dave Landry. I've been around for a while, as Todd alluded to. I'm a pullback trader, which I guess will come in the show later based on this week's question. I like to trade reversion to the mean in the direction of the trend, which again is pullbacks. I think you can only predict the short term when it comes to markets, but you could always stick around longer term if the position moves in your favor. I do have a 21-page report, which was part of an article I submitted for an article contest, which I lost, but it's a good report nonetheless. So if anybody out there, it has an interesting piece on why I lost, I think, the contest. But if anybody wants the report, they're welcome to it. as far as the S&P 500, it's like I'm almost I fully agree with what Steve said. I fully agree with Todd said. It's one of the problems with this weekly panel is some people say there's not enough controversy. We don't get into it enough. But it's the craziest thing in the world. Like I wrote this morning, there's 1,000 reasons why this market should be going down, why it should be a little bit more of a rout, but it's not. And I agree with Todd. It's difficult. It's a difficult class right now, and I fully agree. If you don't know anything about technical analysis, what Todd said about going back to October on a net price change basis, we haven't gone anywhere. We haven't gone anywhere in the Russell 2000 in over a year. So it's very important to, I've been nicknamed the trend following moron because I draw arrows on my charts, and it's very important to draw those arrows. So it's like I'm actually making up my opinion as I'm looking at this market because it's so difficult. I was going to say higher simply because of a lot of the things that Steve said and Todd. It's like this market should be going down, but it's not. So I'm very encouraged by that. I still have some leftover longs. I don't have any shorts on right now, so I'm encouraged by that. So I guess pin me down. I'm going to say lower, and the only reason I'm going to say lower is because I have what's called a bow tie sell signal, and if you get those off of all-time highs, it's usually important to pay attention to them. But I'm going to go with a low confidence. I'm going to couch and go with a confidence of 4 on this one. So one thing I've been writing about a lot is especially in this particular market with the sideways arrow, you really don't want to be doing a lot of trading as a trend follower. And like Todd said, he's got on some gold positions. We have on gold positions too. That's a market that bottomed out. Looks pretty nice to us. But other than that, we're not seeing a whole lot. The REITs are hitting new highs and bonds are hitting new highs, but it's kind of hard for me to get too excited about those markets. So I'm going to go down with the confidence of 4, and I don't want it to go down. I want it to go up and at least just get out of this range and do something, but I would prefer, obviously, if the market just went up. It's much easier to trade a bull market than a bear, as anyone who's traded for more than a little while probably knows. Okay, let's talk about developing events. Let's go back to you guys over there, George and Milton of Unusual Activity, which is a subdivision of Financial Juice. What developing events, they can be technical or fundamental, will you be watching out for this week between now and Friday that might have a positive or negative impact on the S&P 500 and other U.S. markets?
All right. Well, let me just go quickly on the technical side. We look a lot on the ES futures. We're looking at this 2,000 number on the ES futures as it's like a magnet. They're trying to defend it for the bulls are trying to defend this number to the downside. If we see this number continuously broken, we believe that it's going to be an indicator of a 3, 4, 5 time break. It's how much longer can these people hold this before it actually collapses lower. So we're watching that 2,000 number on the ES futures, keeping an eye on the volume also as well. Key indicators that we're watching, George and myself, we're watching ECB. We believe it's like I believe someone else mentioned it's cooked into the market already. We believe. Unless they come out with a blockbuster number, like a bazooka type of, QE, we believe it's already factored in. Greece is a mess. What happens on the voting over the weekend in Greece is going to be a lot of people are pushing it aside. But we believe it's going to be a big factor down the road. And oil, it's all about oil. We believe, the weakness in oil, the comments over the weekend by J.P. Morgan and people believing that oil could break that 40 number. If oil continues to weaken, we believe the markets will fall into place as well. So that's a few of the things that we're looking at, keeping a close eye on, and seeing technically in the fundamental side what happens on each of those future events.
And a few other things just to piggyback on Milton's comments, and one is the ECB certainly, but not just what they will have as a statement, but really what kind of commentary they will have, not just the actual numbers that they're going for, the asset purchases, but really what's going into the future. And really specifically what we're looking for is any commentary with respect to the deflation word, that's entered the lexicon. Number 2 is, that lower inflation expectation, certainly inflation expectation of 2% globally. from the central bankers, that we feel will be in focus as well. Certainly, I know, Todd, you have a history of foreign exchange, but certainly one of the things that we've been highlighting recently is the strength in the U.S. dollar versus the euro. We feel that that's a bigger story here going forward. We're now starting to see.
I totally agree. Totally agree.
Yeah,
Yeah, I agree with both you guys.
We're starting to see earnings come through. We've had disappointing numbers from the big banks, certainly lower trading volume. Activity pops up, their trading volume, their trading revenues will increase. I mean, that's a no-brainer, right? Even Moynihan mentioned that this morning in Davos. But really, it's the commentary, folks. That's what we're really looking for, and that provides a little bit of extra volatility within the market space in terms of opinions. The more opinions that more to the down or upside, the more volatile we feel that the market will continue to be. So that's something that we're keeping an eye on very closely.
Oh, good stuff. I ignore all news, but I always like when you guys come on because I find out what's really going on in the markets, and you always have
Dave,
a lot.
I get my news from TMZ, so it's fun.
Okay. Yeah, Todd, I'd watch you more often, but I don't watch the news. All jokes aside, I do enjoy when you guys are on. You bring up a lot of interesting points. I'm headed back to Europe in a few weeks, so I'm kind of pretty excited about the euro being with the $1.17 handle. First time I went over there, it was like 2-1, and it was the first time I ever traveled where the dollar, nobody wanted the dollar. It seemed like before that I've gone to places where they cared about the dollar, but they didn't at all. Just a real quick, George and Milton. What impact do you think? What is the story you think with the euro dropping? What type of implications do you think that's going to have, or ripple through the markets? What's your feel on that?
So here's the thing. We're going from macro perspective, right? The U.S. dollar being so, I don't know if you want to call it overvalued. If you pull up a 10-year chart, we're actually above that 10-year chart back. I think it was 92.63 level. We're actually, this morning we went above that. Really, we think the implication here is on the multinationals here in the U.S. because when they start to report on, and if remember when they repatriate those funds back into U.S. dollars, it's going to have an impact. We may not see a lot of it now, but a lot of these, exporters. Remember, exporting is now really expensive for U.S. companies, right? There was conversation between even Chinese decoupling from the U.S. dollar because of the strength in the U.S. dollar. So I think it's more of a macro question and an earnings question when repatriating those funds back into the U.S. dollar.
Yeah, it's always fascinating. It's like sometimes you get what you want, and then it's a bad thing. It's like you want lower oil, but now there's implications with lower oil, so it's crazy.
And there is, and by the way, there is a slight correlation, an inverse correlation between the U.S. dollar and the oil, and I'm sure those of you who have been watching it rather closely, very interesting, especially on the severe volatility when you have that huge moves in the dollar versus the oil. You actually see some interesting inverse correlations. I just wanted to put that in there.
No, good stuff. No, I always tell people to make sure you read Intermarket Technical Analysis by Murphy. Make sure you understand
what a great book that is.
Yeah, fantastic book. The bottom line, though, it took me years to learn this. Now, I think the couplings or decouplings or the inverse relationships, however you want to look at it, the correlations is what I'm trying to say, not couplings, but correlations. They used to be a lot easier to figure out, but nowadays I find they only matter when they matter. So it's something to pay attention to when it's working, and then when it's not working, then go off and do something else. But yeah, absolutely, it's I think everyone should read it and understand it. Don't try to apply it too much on a day-to-day basis, but when you start seeing those correlations line up, whether they be in line or inverse, it can be very powerful stuff and good confirmation.
Dave, can I jump in on that point real quick, or do you want to move
absolutely.
on?
No. Come on. No, absolutely.
Okay. Yeah. Was that Milton making that point right there, or was that
It was George.
George?
George.
Okay. Hey, yeah. Great point George makes, and Dave brings up, and John Murphy is I consider the godfather of technical analysis. Dave Landry in a close second, but
No,
no,
checks in the mail.
but yeah, right. But no, it's very interesting what the dollar's doing, and George is exactly right. There is a long-standing inverse relationship with the dollar and the S&P, and that's I say to my clients, I just hate this direct dollar S&P relationship. And the last time the dollar traded directly with the S&P was, believe it or not, leading up into the NASDAQ bubble prior to 2000. So what Murphy said in his book is, once we crashed the NASDAQ bubble, that's when we started to see signs of deflation being brought in from Asia and Russia, the Asian currency crisis, and long-term capital management and stuff like that. So if we're in a deflationary environment, generally stocks trade inverse to the U.S. dollar. What I've been saying to customers is, despite this drop in oil, the dollar and the S&P relationship are starting to suggest that we're seeing something back toward 1999 to 2000, which U.S. being the hottest game in town, direct stocks, direct dollars. So if we're in fact in a sustainable bull market, which I believe we are, I don't think this inflation is going to become, or deflation is going to become a significant problem if we can sidestep what's going on in oil. I think this direct dollar S&P relationship lasts for a while. I think the S&P goes higher. So I hear what you're saying. Traditionally, dollar stocks trade inverse, but that is in a deflationary environment. If, in fact, we're able to sidestep this oil and disintegration of the Eurozone, then I think S&P dollar trades together.
Yeah, I mean, and that kind of dovetails back to what I was saying about, you can take the classical relationships and look at it, but it's like they only matter when there's a correlation
Right.
there. Now,
Right.
it's tough, and it sounds like a couch, but you just have to observe it. I'm sure there's some sort of correlation analysis you could do, but I try to keep as few moving parts as possible. But I think that's probably some pretty good fodder for research. Steven, we got a little sidetracked here. Before we get too far sidetracked, what developing events, technical or fundamental, are you watching, or will you be watching out for this week that might have a positive, negative impact on the S&P 500 and other U.S. markets?
Sure. I'm going to piggyback on a lot of stuff that was just discussed. So we're talking about correlation breakdowns, and let's just take a step back for a second and talk about how unprecedented some of this action is. Would you expect oil to crash 50% with the S&P still 4% off of its all-time highs? It's not something that you would expect to happen. You would expect the S&P to have corrected a lot more relative to this oil decline. We also have treasuries and the rates there, which are at all-time lows, and you would think with, for example, TLT spiking higher, the S&P would be down further. We also had a flash crash in copper last week, and we had the big move in the Swiss franc. And then we have recently gold, which is seeing the largest short-term rally it's seen since 2007, going along with the rally in the dollar. That correlation's completely broken down in the short term. Normally,
Absolutely.
Gold is kind of an inflationary measure, and you would see the dollar dropping with gold rising, and it's just so goofy right now. This is great talk, and it's good cocktail party kind of talk, but it's just not. It's not massively actionable for me right now. In my opinion, I think a lot of this macro stuff will get pushed off until after earnings season. So I think the big fundamental stuff that's going to come through right now is whether or not earnings will suck as bad as what the market's currently pricing in. So if you look at oil stocks have dropped significantly. So these stocks have been cut in half in anticipation of low oil prices causing those companies to not do so well. The question is, has the market efficiently priced it in? Will we see really, really ugly news out of these stocks, like, let's just say Baker Hughes, which reports this week, or maybe Chevron or Exxon, or you can go to oil service stocks. If they see ugly earnings reports and those stocks fail to sell off further, that's going to be a positive note for the markets. That means that we're already priced in a lot of stuff. Those that needed to sell have already sold. So earnings season, I think, is going to be really, really big right here. In terms of technicals, there's a big level I'm watching on the S&P right now at 2050. That coincides with a flat 20 and 50-day moving average, and it's just going to be a good pivot level to watch. And my thesis here is a failure to get back above 2050, maybe not necessarily by the end of the week, but maybe like next Monday or Tuesday, indicates that there's not enough buying pressure at these levels to get us back to a more healthy and sustainable market, and then we may see a rollover. Also, I'm watching that 1975 level. I would not be surprised if we saw a failed breakdown where we break underneath the December pivot lows in stocks, and everyone says, all right, the breakdown happened, it's time to really push this to the short side, and then the breakdown fails. We've seen that pattern work many times. So with that kind of setup, you wait for the breakout underneath 1975, and then you play the reversal if the reversal happens. If it doesn't and it gets ugly, that's fine, but then you're not even in the trade. So
I totally agree with that, and I'm not a reversal type of player, but that's also, you know what else is it right at that number? 200-day moving average, and that's going to be well watched, and that's going to be a big deal with a lot of people. It's kind of interesting that I've heard some of the poorest arguments for stocks on this show in the last couple of months that David has been kind enough to have me on. A few weeks ago, it was where else you're going to go, and I thought that was a horrible argument for stocks, but I agreed with it. And then now it seems like the theme this week is, well, they're not going down, and the world's coming unglued, and that's not necessarily a great reason to rush out and buy stocks either. But
one of the best mental exercises that I suggest to my clients, you have the Drudge Report, and they have archives. So you can do a Drudge Report archive search, go back to a year before and go back to 2 years before, and the headlines always suck. You know, there's always some kind of ugly ECB meeting coming out, and there's just been disaster imprinting where the perception of risk is always super high after just any kind of tiny pullback. That pattern won't persist forever, but we've just seen time and time again, anytime we get a little bit of a squiggle to the downside, way too many people get involved in hedging, and the VIX spikes, and volatility futures markets go all sorts of wonky. And that's
Steve,
what we're seeing.
The one thing I would just push back, I agree with what you're saying. The one thing I want to push back on a little bit, I'm curious to your thoughts, would be gold. You were saying it makes no sense in terms of what gold's doing right now. And I think one thing that people don't quite realize is gold can rally in an inflationary environment, but it also rallies and it acts as a safe haven in a deflationary environment. I mean, we have gold and bonds rallying right now, which is spiking volatility, which is right in your kitchen. Actually, I just took profits on half of a gold position into $12.95. So, I mean, I feel like this is a vol hedge right now, and to see dollar, gold, and bonds rallying together right now, I think makes perfect sense because volatility is the highest been in probably 2-3 years in the markets. No,
the traditional correlations between the dollar and gold. That's the only thing that I'm having an issue with. Normally, you would see some kind of pullback in the dollar, and here's the interesting thing: if the dollar actually pulls back, you know, does gold have more mojo to the upside? I think right now, statistically, gold is overbought. This is a very large rally in a 5-day period, but it's kind of a shot across the bow to me. So, you know, that's the only. It's not that I don't think it's crazy to happen. It's just that we haven't seen that kind of movement with the dollar spiking in quite some time.
Sure. One thing on the gold, and I'd love to know if you guys do this as well. Gold is incredibly interesting. We were on CNBC a lot talking about the gold breakdown as we're through 1180. Do you guys ever go on weekly charts, monthly charts, switch over to log scale, do your traditional technical analysis, and see how those levels change? If you guys were to just bring up a weekly gold chart from 2002 low, which is around $250, $280, you switch over to log scale, Dave, if you just draw your trend line, put an up arrow, you'll see we've held trend line support on gold into that 1180, 1200 test. So to see gold moving higher, I actually think it's just a technical move. We are above uptrend support on the gold market.
Yeah, good stuff. Hey, Todd, while we have you, let's go ahead and get your opinion on what developing events. So they could be technical or fundamental, or you're going to be watching out for the remainder of this week, and it's for the now between Friday's close of the 23rd.
Sure. Everyone's mentioning it's the ECB, and I think everyone wants $1 trillion, and they need to. They got to bring the bazooka, or else we haven't seen volatility yet. So I'm actually just babysitting positions. Like I said, we've been long a 120, 125 GLD call spread, and we're almost at max profits there. So I've just been playing the volatility leading up into this event. What happens after, I frankly have no idea. I think the easier trade has been a technical move higher in gold. S&P, as we all tossed it around saying basically we don't know. It could go up or down from here, 50-50 chance of that. So I do think crude and euro are directly related. Steve was saying crude and the dollar inversely related. So put in other words, crude and euro trading together. I think crude has one more little test down. I'm an Elliott wave guy. That would be a wave 5 low. Euro, I also think, is approaching a near-term low that would set up a several 100-point rally. I've traded for an FX hedge fund. That's kind of my background. It would just be the currency ways to say, screw you, to come in with something slightly disappointing or maybe as expected, shorts come in and rally the market ahead of just following ECB. I have a feeling they're selling the rumor, buying the news. So I'm actually looking for a rally in euro post ECB. So that's not something I'm going to trade. I don't have the backbone for that one, but I have a feeling they're going to rally this euro.
Todd, have you ever traded the FXE options?
Oh yeah, all the time.
Okay.
Yeah, I love them. And it's a great question. I know you're an option trader, and we were talking about this on CNBC. So many people got crushed on the Swiss franc move just by being long, for a futures contract or a foreign exchange contract. What a great time to just be long options ETFs. All you're at risk for is your premium. If you're trading currencies in here with such massive volatility, I think the currency ETFs are the way to go. FXE, FXY, FXF, which is your Swiss franc ETF. A lot of arguments to be made for trading those currency ETF options right now.
I just hope those options get a little bit more liquid. I mean, they're
Swiss franc is a liquid.
More liquid in the past, but that would be very nice to see more participants come into that market.
Yeah, I think so. The Swiss franc is pretty liquid, but FXE is fine. You can do what you need to do in there.
I think it's interesting you use the word bazooka for the ECB. Again, I try to ignore all this stuff, but Rob Hanna, who's a friend of this show, once said in a speech at a AAPTA meeting once, that's American Association of Professional Technical Analysts, not AA meeting. But anyway, he once said that the Fed's intervention has been, it's kind of like a drug. At first, just a little bit, it takes just a little bit to get started, and then it's been taken more and more. And with each intervention, we've had less and less upside from it. And I think that Europe is probably stuck in that trap now of like you said, it's going to take a bazooka to get something going. Okay, well, back to ignoring the news. I ignore all news, and I'm just a technician. One thing that I did want to mention I thought was kind of interesting in listening to all the news and all the news events, especially what you said, Steve, about the Drudge Report, which I think is a pretty cool thing to do, and I think that I might mention that at some point. Greg Morris does a pretty good speech where he gets up and he shows a chart. I'm not sure what's a chart of, but I'm sure it's equity related. And he talks about the fact that he starts telling you what's in the chart and what news events, and then wants to see if anybody can pick them out, and you can. He talks about the Asian crisis. He talks about LTCM. By the way, Todd, I can tell with young guys like you, I can always tell when you've been around a block or two and you know money management because you mentioned long-term capital management. Anyone who's not lived through that doesn't fully understand money management. But that's we'll talk about. We'll have a beer one day and we'll talk about these things. But it's fascinating.
Down and have a Bloody Mary with you down in Bourbon Street.
Absolutely. Anytime, man. But it's fascinating that he does go through. He talks about 2 Gulf Wars, and he just lists 9/11 and all these other things, and they're very hard to pick out in the individual chart. And obviously, they do have some short-term effect, but longer term, the market just kind of goes where it wants to go. With that said, let's talk about this week. One thing when I first started doing these shows, I was a little nervous because I'm not a guy that's going to try to predict every market all the time, and especially like now with the S&P just kind of chopping around. But the fascinating thing I think that's really good for the people that are viewing this is that we have these great professionals on, and sometimes we disagree, but it's like a lot of times we just come out and admit we don't know. And I think it's important for the novice trader out there to know that we don't always have the answer. Sometimes we get fairly confident, But even then, the money management is still crucial. So I think that's one of the great. That's why I love coming back and doing these shows, because I always learn something, and then everyone's always talking about they're never 1,000% sure that the market's going to do a certain thing, and they realize they could do whatever it wants. Now, before I pontificate too much, S&P 500, 1975. I learned from this show. It looks like everybody and their brother's watching that. As I was telling Steven a second ago, it looks like the 200-day moving average is pretty close to that. A joke I made years ago about technical analysis, no matter what you do it, a lot of times all the technicals come together at one point. It's like the Cajun joke about the thermos that keeps the hot things hot and the cold things cold. How do it know? So it's like, how do it know? How does a 200-day moving average know that that's also a support level back from December, right around that 1975? So I think that's going to be crucial. We do have a bow tie sell signal, as I said, coming off of all-time highs. That could be a very powerful sell signal. The last time we had one, the market dropped about 8%. When I say powerful, I mean like multi-year tops can occur from that. I'm not feeling it this time. It doesn't look that scary. It doesn't look like a route lower like we all said today. The market's not coming unglued, and there's plenty enough reasons for it to come unglued. So I do think we have a sell signal. I do think you have to watch 1975, the trigger on the sell signal. And if anybody wants the bow tie pattern, just email me. I'll be happy to send it to you. I'd say if the S&P got below, let's say 1995, which would be a little bit wiggle room below today's low so far, I would get a little nervous about that, a little concerned. I wouldn't rush out and short it. I think trading indices is a lot tougher than individual issues, but I would get a little cautious. I like what Steve said. If that gets broken, let's keep an eye on that 200-day moving average, which was right around 1975, and then maybe let's see if we can bounce off of that one more time. Just to throw out one more thing, what's a little concerning is the people that came in since 2009, as I alluded to before. You know, you got the Todd Gordons out there that lived through LTCM and things like that. And Steve, you've been around for a while too, so you know. And I don't know George and Milton that well, but I'm guessing they've been around for a while, and they've seen such world events. Everyone since 2009 is kind of drinking the Kool-Aid that this market is going to go up forever. I hope it does, because I'm a trend following moron and I'm drawing my up arrows. But someday I can promise you that it won't. Markets go up and markets go down, and it's amazing how many times people forget that. So keep an eye on those S&Ps. As long as we're mostly sideways, don't make any big picture predictions. You don't get a prize for calling a top, but just wait for the market to tip its hand and then look to take some action. We're going a little long today, present company included, but I think there's some good stuff that's coming out, so I'm going to keep on going here. Okay, let's get to the open-ended question. Let's go to now George and Milton. I don't know directly what type of trading you guys do, but or how this relates to you. Is everything actionable signals from developing events with you guys, or let me ask the question. I guess I'll let you answer it. What styles of trading or methodologies have you had the most success with? So I'll just let you guys answer it.
Well, initially, we've, myself and George, we've been around for like, what, 10, 15 years, George?
A little bit longer for me.
Yeah, and initially I was
on the 18 side.
Yeah, initially I was a technical trader, so I did technicals for maybe 5 to 10 years, and then slowly started getting into the news and options trading. So
the website is new, but you guys aren't.
That's right.
Yeah.
That's right.
Okay. All right. Good.
Yeah, I'm like a day-to-day, minute-by-minute type trader. I don't look what's going to happen 2-3 weeks down the road. I don't. Basically, I could care less what happens down the road. I look at what's going to happen, in 30 minutes to an hour to 2 or 3 days at max. So typically, I'm a very tight, technical trader with actionable news and actionable options, unusual option trades. So that's just the way we trade it. We technical-wise, we use support resistance levels a lot, and then it's just actionable news and options.
Okay, cool. That's fascinating. All right, Steven, tell us what style of trading or methodologies have you had the most success with?
Let's just talk about what's working right now. I tend to focus on market cycles, so it's not just about up, neutral, down. It's also about the trendiness of the market and what volatility is doing. So we've been in a big, dumb, ugly, stupid trading range for about 3 months. That means a subset of trades called income trades have been working very well, things like calendars and iron condors and butterflies. So that's more on the short volatility side, and those trades work very well when we see reversion, and that's basically what this market has been doing well. I don't think that will persist for much longer, but that's a kind of trade that's done incredibly well. I've also started to pivot towards long volatility trades because we're to the point where it's reasonable to expect some kind of a move. It doesn't matter which way, but something between now and Friday is going to happen. Now, if you look at, for example, something like Apple, Apple's been in a trading range, and the weekly straddle, it's a combination of a call and a put, it's going for about $3. So as long as you see a $3 move in Apple in either direction, you're going to make money. Apple's got resistance at 112. It's got support at 105. It's probably going to see a 3-point move. We've got some earnings. We've got some fundamental data, and that's going to be a good strategy, I think, for the near term. Look for cheap weekly options. Pick up some straddles. Your risk is limited, and if we do see a decent move, you're going to make some money. And then also, we're coming into earnings season, so I'm a big fan of trading options around earnings. I think there is a very distinct edge that you can get as a retail trader because institutions really can't put on these kinds of trades. So something I'm looking at right now is Netflix reports soon, and I'm looking at a long volatility strategy in Netflix and maybe something in IBM. So right now I'm not really focused on a ton of directional trading. I think it's a very, very hit-and-run market with individual stocks. Overall, the S&P looks great, but individual stocks are not. Stuff like Google and Baidu just kind of middling around. So I'm focused more on volatility right now until we get a better feel on the overall trend of the market.
Cool. I like that. My big problem with switching styles is you could end up perpetually out of phase. But I think it's cool that you talked about some reversions and mean things, but that's been working for a while, so that's due to stop working. And
yeah, as soon as income trades look very obvious, that's when they start working. So you just have to accept that fact.
Yeah, and a lot of people are, I just stick with one style because I think you get in a lot of trouble if you change styles too much, because you get a little too full of yourself when you start doing really well.
I am quite full of myself.
You forget no. You forget that. No, I like the way you point out that, hey, it's been working, but it's not going to work all the time. All right, Todd, let's go over to you. Tell us what styles of trading or methodologies have you had the most success with?
Sure. Like I said, a little bit more detailed technical analysis. I do try to respect the trend a lot, like you, Dave. I try to use actually a big influence on me early on was Kevin Haggerty, which you know well.
Yeah.
He always took a big kind of fib, kind of a Gann Elliott approach. So what I like to do is use all those tools basically just to do what we're supposed to do in trading, which is to buy weakness in rising markets and sell strength in falling markets. And I've traded some vol, some short premium strategies, as Steve was saying, and the way I do that, and I'm actually about to put that trade on here in gold, is using Elliott. I think we've just rallied up in a third wave in gold. That would mean that we should be in a fourth wave consolidation for some time. And like I said, I think vol is going to come out of the macro markets here heading into ECB, so I want to be short volatility into that. I'm just looking at the charts. The fourth wave should be approximately a week to 2 weeks. It's looking at the same degree waves within the rally. So what I like to do is once we've exhausted a trend, I like to go in and look at prior corrections to determine from price and time how long those corrections should last, and then that helps you determine your strike and expiration selection. So you can be short premium that way. But the success I've had is identifying soon-to-be breakout moves, which are traditionally your wave 3 move. You figure out where the move is supposed to start using fib retracements, and then you figure out where that wave 3 is supposed to end using fib extensions and projections. So that kind of gives you an idea. It's definitely not perfect all the time. It just gives me a slight edge over the market, and I basically buy options where the move is supposed to start and sell options based on where the move is supposed to end. So, the GLD is a perfect example. We had a nice trade there up in wave 3, and I think that's the only thing, just this vol kind of move ahead of the ECB. I like to be short premium. Maybe I'll do like a 13 and in the gold futures, maybe like a 1300, 1310 call credit spread, and maybe like a 1270, 1260 put credit spread. And just in the weeklies, as Steve was saying, you're not going to go out too far in this. This is just a short-term consolidation, and see if we can collect some premium on the way back. But I think directional trades in the right market that fit within the context of what you like the intermarket play, I think that's the money right now. Dollar, gold, bonds. I don't think you need to go to individual stocks right now because the major macro markets are trading so well right now.
Yeah, you've identified something that's really key. I'm not a big fan of Elliott Wave. I mean, I keep things really simple.
Yep.
But what you've said is key. I think the reason I'm not a fan of Elliott Wave is most people, I'd say 95% or maybe even higher, the people that use it, they try to use it as a be-all, end-all, and they're always trying to catch a top or a bottom.
Absolutely.
And what I've seen some people that have been successful with it,
yep,
as long as they're trading with the trend, but then they get a little full of themselves, and then they start trying to catch tops and bottoms, and they seem to fall in the same trap. So I think regardless of your methodology, if you have something broad stroke, I still think the trend is always going to be your friend when it comes to markets, and there always will be trends. And I think that if you trade, use whatever your bottom analysis is, your basic analysis, whether it be Elliott or whatever, or classical technical analysis like I use, have that as kind of your base, but then look for some sort of trigger or signal or trend within that, and I think you'll do just fine. So yeah, I was kind of interested to hear you take on Elliott, and unfortunately, once again, we have no controversy on the show, but we'll.
To your point, you can make Elliott as difficult. You can use it for evil, or you can use it for good, as I described. And I think
like
the real benefit is, or the strength is, yes, it's subjective, but I only put trades on when I have at least two wave counts saying we go in the same direction. The exact, the academics of it is say, what's the exact wave count? That's for forecasting. I don't care about forecasting with Elliott. I care with trading with Elliott. And I'll always have myself backed up with two counts and say, okay, I think the market goes from 1300 in the gold futures down to about 1260. Two wave counts say that. That's the first thing. So embrace the subjectivity. It's a trader's methodology. It's not a forecasting methodology. It's trading. It's where I define risk and reward, importance of ruin, and points of validation. The other part is all you need to do is identify three corrective patterns. There's only three corrections in the Elliott wave: flat, zigzag, triangle. All you're looking to do is identify one of those corrections, buy the pullback in the course of the uptrend, and leave the top picking to maybe 10%, 15% of the time. But if I try to top tick a market like I'm going to do here in the gold by being short premium, it's going to be with a damn tight stop. I know I'm not good enough to pick the top of this move, but I'm going to try, but I'll do so with a very tight stop.
Amen. Amen. Okay. As far as my trading is concerned, I do a presentation, and I think there's a few of them out there. Not from me directly, but with other like I'm doing today, other webcasts with other people, where I talk about a trader's journey, and we all start off with a blank chart, and we start adding more and more indicators, and before you know it, it becomes very complex and sometimes a little arcane. And there's so many indicators on the chart you can no longer see the price bars. In fact, next time I get one of those charts, I need to save it and use it in my next presentation. But I get charts from clients all the time. We are used to at least until I tell them to stop sending them to me, where you can't see the price anymore. And I think price is your ultimate thing that you need to watch, because you can't trade off of a moving average or a Fibonacci or whatever. You're actually making a trade on price. So I do just look at price. I don't use any indicators other than the occasional moving average. I got called the trade folly moron because I used to draw big arrows on a chart. That was in the late 90s and the market was going straight up. I would draw big arrows, and then people had valid arguments as to why the market was not going up, yet it went up day after day after day. So as I said earlier, I'm a reversion to the mean. I used to argue against reversion to the mean trading until somebody pointed out to me that I trade reversion to the mean. I just trade it in the direction of the trend. So in other words, I trade pullbacks. You can only predict the short term, in my opinion, but I think it's very strong about that opinion. It's fine if you have. It's not my way or the highway, but I know almost to a fact that you can only predict the short term when it comes to markets, because we don't know where the market's going to be a year from now. Everything we just heard in this presentation, especially from the guys over at Universe of Unusual Activity, there's a lot going on right now, and a lot could happen. As I say, instead of reading the disclaimer to everyone when I give a speech, I say, okay, all predictions are about the future, and a lot of stuff can happen between now and then. So I think a lot of stuff can happen between now and then. Money management is vitally important. When a trader comes up to me, if I give a speech somewhere, everybody rushes the stage and asks about bow ties or some pattern or whatever, and I'm happy to talk about that. But when somebody asks me a money management question, I realize they've made it. And I think one of the crucial things, and I didn't realize how important it was until more recent years, where I've given some presentations to a higher end audience, to money managers and such. And the important thing is to scale out of a position but hold on to the position for a longer term gain. In other words, always position yourself for the potential of an unlimited longer term gain, and that's where the real money is. On any particular position, I know that, again, I could be fairly wrong, but if I'm right, I could stay with it as long as it moves in my favor. I could take some profits and then position myself for that longer term gain. And the secret to that, the secret is no secret. You just give it enough room to move shorter term, and then you slowly allow that stop to widen out after you take those partial profits. And that's a very simple type of money management plan, but allows you to kind of have your cake and eat it too. And that's why I call my approach a hybrid approach, because when I get into a position, somebody asks me what's my holding time. It's like I hope to be in a position 10 years from now. But obviously the money management will take me out a little bit sooner. So, but anyway, if you have the proper money management, you should be able to position yourself for both short-term and longer-term gains. I think that's
Dave, I gotta ask you. I gotta stop you. What is different between now and 2000? You loved the trend back then. What is different than this uptrend? I mean, I respect you as one of the greatest trend followers there is. What is different about this? I mean, we're only 2090 S&P high. We're at 2014. We're 75 points off the high. How are we not still in an uptrend? I know it's a bow tie setup, but I mean, this is one of the fiercest uptrends we've ever seen. No?
Well, the thing that I cautioned earlier about is since 2009. Everyone is kind of drinking the Kool-Aid, likes to go up forever, and then they've ignored the sell signals. And I talked about Judd Dotery from Standian Capital Management. I probably said the name wrong, I always do, but he's over there with Greg Morris's firm. But he said in his book, Investing with the Trend, that those active managers who have keeping pace with the market should be questioned, because they're probably not taking the evasive action as necessary. So my point is that you get a move like, if you go back and study, let's say October last year, we had a bona fide sell signal then, and had you ignored it, you'd probably be okay. But one of these times it's not going to work. So the problem with the trend now is that we keep having these sell signals, and I think sooner or later they're not going to work. But I'm not going to argue that we're not in an uptrend, because we obviously are.
Yeah.
And as soon as this market starts hitting new highs, I'm back to being bullish again. Now we have 5 longs in the portfolio. One's gold, so that doesn't count.
Yep.
But the other 4 are left over from the last leg up. So I'm not going to argue and say that we're not in an uptrend. In this particular case, we're so close to 200-day moving average. That's probably a good thing to keep an eye on, and it's got a really nice slope to it. So if we get below it, not a dip below it, but if we get below it and stay below it for a significant amount of time, the problem that's going to happen is we're going to build more and more overhead resistance. All of the Johnny-come-latelys that bought late into the game and all. So I think we're still in an uptrend, but I'm a day-by-day guy. So I'm not going to argue that we're still in an uptrend, but we could get like I said, we could get a signal here on the sell side. And I guess the point I'm trying to make is all sell signals have to be taken seriously.
Time frame and target matters here too. So if you back it out to a monthly chart, that's going to look completely different. And since we're on a weekly show, we got to talk about something, right?
Yeah, amen. Yeah, monthly still looks pretty good. The big blue arrow is still pointing up on that. On the monthly chart. So
I just say don't overthink it. I think we're in fundamental territory that has never happened before. Nobody knows the implications of these Fed balance sheets. I think to your point, Dave, I think it's time more than ever to forget the fundamentals, forget the story, and just buy pullbacks. I mean, I don't know. I say I'm smart enough to know that I'm not smart enough to pick the top of this rally.
I'm a member of the American Association of Professional Technical Analysts, and that's how these, I try not to name drop it, but somebody always says something good. I always have to talk about them, like Todd or Greg or these people. And I always get something good out of these meetings. And we had Ed Zakoda talk to us last year.
Yep.
And Ed's kind of out there. But I tell you what, the one takeaway that, and I wrote it down in big notes in my notebook, that Ed said. He said, based on the craziness of the governments and the environment that we're in, we're going to have bubble after bubble after bubble.
I agree.
He said that like, oh, margin call. He said that, don't answer that margin call.
Right.
Just kidding you.
No,
and I think that's something that we need to pay attention to. And it's like, there was a bubble in coffee a while back. There's going to be, and we could end up in that crazy type of environment. So we're in uncharted territory. I agree. We could, even though we got a short-term sell signal here, like, I know we have to have something to talk about.
Sure.
But I could see a blow-off of the S&P just like a blow-off in any other of these markets could happen. So I think that's something that, in fact, I actually wrote about the bubble thing this morning in my column, and I think that's very important that people write that down and just start watching for these bubbles. Take a look at real estate right now. It's starting to act like, take a look at the REITs. They're acting like internet stocks from '99. So just keep an eye on these bubbles, trade them, have a chair for when the music stops, and then maybe look to short them when they begin to burst. So, well, this was I had a blast this week. This has been a good show. David, do we have any closing thoughts before I close? Well, let's go to George and Milton again. Any closing thoughts, George, Milton? And again, we're running a little late, but any other closing thoughts or anything else you want to tell us about unusualactivity.com?
Again, Unusual Activity, you can find us on financialjuice.com. So what we do, we provide a real-time market information platform, and we filter it with volume and price. So it's not just the importance of getting the story or getting a particular headline that's circulating around desks, but its implication on specifically in price and volume, price action and volume volatility, if you will. So that's what we do. We've been watching these markets for quite a while, as we mentioned before. But again, we feel that in addition to technical analysis and everything you folks bring up, at times, fundamentals and macroeconomics do impact markets, and traders should have some idea what really is impacting markets and how to react to that appropriately.
Yeah, cool stuff. Seeing identifying where that money is flowing, that's really interesting. Okay, Stephen Place of investingwithoptions.com. Any closing remarks or anything else you want to tell us about investingwithoptions.com?
Well, first off, let me put my hat in the ring for Financial Juice. I do go on to the Unusual Activity every once in a while. If you're an intraday trader and you're looking for hot money, they've got good options order flow and everything else. So I'll go ahead and give them a little boost too. So about me, just check out investingwithoptions.com. And that's pretty much all I got today. I got to go eat lunch. So my brain is fried right now.
Yeah.
I heard that you're in New Orleans or around that area. My in-laws actually own a gallery on Royal Street, so you definitely got to check it out when you're down there.
Oh, absolutely. Let me know when you're in town. We'll find some trouble.
Yeah.
All right, Todd. Any closing thoughts or anything else you want to tell us about tradinganalysis.com?
Sure. It's it's been a pleasure to work with all you guys, and Dave, great to catch up. And we all run research and signal businesses. I think we're all fortunate to be in the industry we love, and I don't consider it work, and I'm sure you guys don't as well. We're all very lucky. So, the important thing is to find somebody that you can trust, and somebody, obviously, you could trust. That's not the right way to say it, but find somebody that works with your personality, your style of analysis, because if you're in the middle of a trade, you really need to have confidence in whoever you're working with and whatever methodology you're working with to see the trade to its fullest potential. And to Dave's point, keep a piece for a massive move. So whatever business you choose to go with, find one that works and jives with you and you feel comfortable with, because that's how you have a long-term relationship. And I've got over half of my clients have been with me for over 6 years, and I think in the retail business, it's I don't think you'd find that a whole bunch except for the 3 other businesses on the phone here. So that's all I would say about that.
Yeah, I think you probably broke a record there. That's pretty impressive. It seems it could be a revolving door, and that's something I have a
Yes.
hard time wrapping my head around. But it is what it is, and I could have 100 clients, and they're all getting the same information, and half of them do incredibly well, and the other guys just don't get it. So
you said it. It's managing money. That's all what it comes down to, is how can you manage the capital.
yeah, absolutely, and I agree with you. You have to find something that makes sense to you, and you have to fully understand your methodology, and that's a big piece of the money management, is fully understanding the methodology, and a big piece, even a bigger piece of the psychology, is knowing that there's going to be flat times and drawdowns and all of these things. We've gone kind of long. Again, I've had a blast today. So let me just say, if anybody has any questions about anything I said, Dave@DaveLandry.com. I do personally answer all my emails, so feel free to shoot me an email if you have any questions, or visit DaveLandry.com. There's a lot of free educational material there. David Cosminer, let me turn it back over to you and let you wrap up.
Okay. Thanks, guys. Great discussions this week. So I just want to say real fast that if anyone watching hasn't had a chance to see this report or wants to see any previous reports, just go to TimingResearch.com/reports, and be sure next weekend to fill out this week's survey at TimingResearch.com/current survey. So again, I just want to thank my guests for being here this week. George and Milton of FinancialJuice.com, Stephen Place of InvestingWithOptions.com, Todd Gordon of TradingAnalysis.com, and again my guest host, Dave Landry of DaveLandry.com. So thanks, guys.
Thanks, guys. Had a blast. Appreciate it very much.
Good stuff.
Thanks a lot. Take care.
See you guys.
Hey,